Welcome to Doc Does Financial History, where money, power, and history collide, and nothing is ever as simple as it looks. You walk into the bustling lobby of Enron's headquarters in Houston, Texas. The lobby is sleek, modern, buzzing with energy. Traders are on the phone, their eyes glued to glowing monitors. The company logo gleams on the wall. Enron, the energy giant, the darling of Wall Street. You carry a folder with financial statements, projections, and memos. You flip it open, and it all looks perfect. Profits soaring, stock prices climbing. Everything is in order, or so it seems. You head up to your office on the 30th floor. Colleagues greet you warmly, exchanging excited chatter about the latest deal. Enron is expanding into Europe, diversifying into broadband, and dabbling in water trading. Everyone talks about the stock, everyone talks about wealth. And then someone drops a line that makes you pause. Did you see the quarterly numbers? They're complicated. You nod, unsure, because everything looks fine. But behind the glossy reports, the truth is something very different. By the time you leave the office that evening, you can sense the tension, even if it's subtle. The air is thick with ambition, risk, and secrecy. It feels like a normal day at a fast-growing company, until it's not. What you just stepped into is the world of Enron. And in less than a year, the company that once seemed untouchable would collapse in one of the biggest corporate scandals in American history. Stocks would lose almost all their value. Thousands of employees would lose their jobs and pensions, and investors would be left stunned. But how did this happen? How did a company so celebrated by Forbes and praised by analysts fall so hard, so fast? That's the big picture. To understand Enron, you need to understand what it really was. On paper, Enron was an energy company, a utility and pipeline operator. But in reality, it was much more ambitious. Under CEO Kenneth Lay and later Jeffrey Skilling, Enron transformed itself into a trading and financial powerhouse. The company's official story was about innovation, energy trading, risk management, derivatives, and even broadband bandwidth. Enron wanted to be the everything energy company, and for a time, it looked unstoppable. Skilling introduced what he called mark-to-market accounting. This accounting method allowed Enron to record potential future profits on the day a deal was signed, not when the money actually came in. Imagine that you sign a contract that could earn millions over the next decade, and you immediately log that as profit. Sounds ambitious, right? It also sounds dangerous, because the profit is completely theoretical. If the deal doesn't make money, the books still show a profit. For years, analysts and investors drank the Kool-Aid. Enron's stock price climbed from around $30 in 1997 to over $90 by 2000. Analysts hailed it as the most innovative energy company in the world. Everyone wanted a piece of the Enron story. Employees were rewarded with stock options, often making more money on paper than in actual paychecks. The company culture was electric, but it was built on illusion. Here's where things start to unravel. Behind the scenes, Enron was hiding massive amounts of debt. They used special purpose entities, or SPEs, to move debt off the balance sheet and make the company look healthier than it really was. These entities, often controlled by Enron executives themselves, bought underperforming assets or took on liabilities. Enron would report minimal debt, while the SPEs absorbed the risk. On paper, Enron's financials looked strong. In reality, the company was highly leveraged, fragile, and opaque. It's not just the accounting that was a problem. It was the culture of secrecy and aggression. Executives encouraged risk-taking and rewarded creative accounting. When employees questioned unethical practices, many were silenced or pushed out. The company used aggressive public relations campaigns to maintain its image, sponsoring conferences, issuing glowing press releases, and building relationships with banks and auditors to reinforce credibility. And then came the broadband venture. Enron invested heavily in trading internet bandwidth, imagining a future where bandwidth would be as valuable as oil. The deals were complex, speculative, and often unprofitable. But Enron recorded the projected earnings immediately through mark-to-market accounting, adding billions of dollars to the reported profits. Meanwhile, actual cash flow lagged, debts piled up, and the financial house of cards grew taller. By 2001, cracks were appearing. Analysts and journalists started asking questions. The Wall Street Journal began publishing stories about Enron's off-balance sheet entities and questionable accounting. Investors grew nervous. Enron's stock price, which had soared for years, began to wobble. But inside the company, executives continued to project confidence. Kenneth Lay assured shareholders that everything was fine. Skilling championed the company's innovative spirit, and auditors from Arthur Andersen gave the company the green light, despite serious conflicts of interest. Then came the whistleblowers. Sharon Watkins, an Enron vice president, wrote a memo to Kenneth Lay warning that the company could implode in a wave of accounting scandals. She noted that the financial structures were extremely complicated and likely to mislead investors. Her warnings went largely unheeded. Meanwhile, Enron's executives were quietly cashing out stock. Jeffrey Skilling sold millions of dollars in stock just months before the collapse. Other insiders followed suit. Employees, on the other hand, held tightly to their stock options, assuming that the company's sky-high value would continue. When the truth hit, many lost everything. The collapse came fast. In October 2001, Enron announced it had overstated earnings by nearly $600 million over the previous 5 years. The SEC launched an investigation. Banks pulled their lines of credit. Analysts downgraded the stock. In just a few weeks, Enron went from one of America's most admired companies to a symbol of corporate greed and corruption. The numbers are staggering. Enron's stock, once over $90, fell below $1. Thousands of employees lost their life savings, pensions evaporated, and investors were left with worthless paper. Arthur Andersen, the auditing firm that had signed off on Enron's books, was convicted of obstruction of justice for shredding documents, a conviction that ultimately led to its demise. And the personal stories are heartbreaking. Many Enron employees were heavily invested in the stock they were encouraged to buy. Their 401k plans were tied to the company's stock, and when it collapsed, so did their futures. Families lost homes, savings, and retirement plans. The human cost was enormous. So why did this happen? Several factors converged. Aggressive accounting, mark-to-market accounting, and off-balance sheet entities created an illusion of profits while hiding massive debt. Corporate culture, risk-taking was rewarded, questioning was discouraged, and appearances mattered more than reality. Regulatory gaps. Auditors and regulators failed to catch the fraud early, partly due to conflicts of interest. Market pressure. Enron wanted to maintain its sky-high stock price at all costs, leading to unsustainable practices. Speculative. Ventures, investments in broadband and energy trading, were often unprofitable, but reported as immediate earnings. It's a classic story of hubris, greed, and systemic failure. Enron's fall shook confidence in American markets and prompted regulatory changes. The Sarbanes-Oxley Act of 2002 was passed to prevent a repeat, tightening accounting rules and increasing corporate oversight. But the lessons go beyond regulations. Enron illustrates how complex financial structures can obscure reality, how corporate culture can encourage unethical behavior, and how investor trust can be exploited. It's also a reminder that spectacular growth and innovation are not always sustainable if the foundations are weak or fraudulent. Enron's collapse didn't just impact Houston or Wall Street, it rippled across the globe. Analysts, investors, and corporate boards scrutinized companies more carefully. Public trust in large corporations eroded. Banks and financial institutions became more cautious about aggressive ventures. And the story continues to influence corporate governance, risk management, and accounting practices today. In the end, Enron is not just a story of numbers, contracts, and stock prices. It's a story about people, employees, executives, shareholders, caught in a system that prioritized profit over ethics. It's a story about ambition gone unchecked and the dangers of building a house of cards so tall that a single gust of truth can bring it all down. Imagine yourself walking away from that lobby today. The skyscraper still stands. The logo is gone, replaced by new tenants. The city continues to thrive, but the memory of Enron lingers. It's a cautionary tale for every employee, investor, and executive. Chasing growth without integrity can destroy even the most powerful companies. And that's the big picture. From the thrill of rapid success to the collapse of a corporate empire, the fall of Enron reminds us that what looks like gold on the surface can sometimes be just illusion, waiting for the right moment to crumble. If you want to understand more about corporate scandals, the risks of accounting tricks, and the human cost behind financial headlines, dive deeper into case studies like Enron. These stories aren't just history. They're lessons for today's companies, investors, and regulators. Thank you for watching. If you found this video informative, please like, share, and consider subscribing. And don't forget to leave your thoughts in the comments. What lesson do you think is the most important from Enron's story?